Now, before we start, if you're not familiar with financial statements, I suggest to have a look at this video here. This takes you through the introduction to financial statements. What are some of the key statements and what are the key components of those statements? And that will give you a much better grounding to enable you to understand what we'll be talking about here. So financial statement analysis is a way to utilize financial statement data to provide useful comparisons to aid decision making. Now, one of the things that are also important within this analysis is not to just look at one single period. Very often, to make sure that we're getting some good comparative data, you may look over 5 periods. Now, that might be 5 financial years, or if you're doing it internally within your accounts, it could be 5 months, 5 quarters, just enough to try to get some sort of trending information that you're looking at. Our analysis can be broken down into 3 different parts. We can talk about horizontal analysis, and this is comparing with prior periods. We can also talk about vertical analysis, and this is where we will compare with a competitor organization and see how we're tracking against them. And then we can talk about industry analysis. And as the title suggests, this is where we're going to be comparing with the industry average rather than just a single company. Now, all of these give us a different perspective in terms of how we're looking at things, and we can utilize these to get a better understanding of how our organization is performing. So let's start off by considering our operating performance. And here we'll have a look at 5 ratios that can help us try to understand how we're performing. And it is also important to mention there are many ratios that organizations can use and can work out, from dividing one number by another number. And ultimately, it's almost endless as we go through. But here we've tried to focus on 5 of those key ratios. Now, first off, we'll have a look at the trading margin. Now, this is we'll refer to as our gross margin percentage, and is looking at what is our profitability from our sales less our production costs. We'll then have a look at our operating margin. The operating margin, in this case, we'll have a look at our EBIT, or our EBIT percentage, the earnings before interest and tax. And this is trying to focus on the profit that is within a normal manager's control. So it excludes the interest and tax, which is a bit more broader business decisions. And then we'll also have a look at our return on sales. Now, the return on sales is focused on our profit after tax, so our net profit after tax. So really the profit distributable to shareholders, and we'll have a look at what that return is on a base of sales. Now, 2 other metrics that we'll look at is our return on capital employed. And what this is looking at is what is our operating profit as a percentage of the total amount of capital that's been invested in the business. And then the last one we'll look at is return of total assets, or return on total assets. And this is looking at our net profit. What is our net return on the total amount of assets that are deployed in the business? So if we have a look at our trading margin or our gross margin percentage, we calculate this by taking the gross profit from our profit and loss statement, dividing by our net sales or our revenue, and turning that into a percentage. So if we have a look here for Smart Retail, we can see that the revenue was 5995.3. If we're looking at that in thousands of dollars, so actually technically nearly 6 million. But the gross profit was 1337.8. And if we divide the gross profit by the revenue, we get a gross margin of 22.3%. Now, is that good? Well, this is where it's interesting. That depends. And gross profit's one of the ones that can be more challenging. It really depends on the industry and the organization, and also how they account for some of their costs. So it can often be best, really useful as a comparison across periods. And if we have a look back at the previous year for Smart Retail, then we can see that their gross profit margin was 23.4, just a percentage higher. Now, that's not a lot, but it might start asking some questions. Have we had to reduce our sales to try to get the same amount of, reduce our prices, I should say, to try and get the same amount of sales? Has that caused a detrimental effect on our margin? Or have we had to pay more for our products, which we haven't been able to pass on in prices? So this might start signaling a bit of a compression in terms of our margins going forward. If we turn our attention to the operating margin, here we're going to look at our earnings before interest and tax divided by our net sales or our revenue. Now, earnings before interest and tax is often a measure that's used for, to say, an operating manager. They're not usually influencing the amount of interest an organization pays and its tax structure. But everything else can often be within their control. So we'll look at our EBIT divided by our revenue. And if we look at this for Smart Retail, we can see that their revenue, 5,995, just short of $6 million, and they had EBIT of 453,000. Now, that gave them an EBIT or a operating margin of 7.6%. Once again, compare it to the previous year, and we can see that in 2025 it was 9%. So we're continuing to see a very slight decline. Again, it's not incredibly substantial, but it might be enough to start asking some questions around where do we think this organization is headed, and is this something that we can try to address moving forward? Now, just to mention at this point, another common measure that can be used for operating margin is the EBITDA. And if you did the introduction to financial statements, you remember that EBITDA was earnings before interest and tax, depreciation and amortization. Now, that is often used where there's quite a large depreciation and amortization charge that, again, an operational manager is not responsible for. We can also look at return on sales, and this now is measuring our net profit after tax or our net income, and this is the profit that is attributable to our shareholders of the organization. So it can often be a better perspective in the view of our shareholders. Now, again, we're dividing our profitability by our revenue or our net sales to create that percentage. And for Smart Retail here, we can see that in 2026, their return on sales was 4.7%, and compare that to 2025, it's 5.8%. So what that tells us is that 1% that was lost at our operating margin and our gross margin position has really flowed all the way through down to the bottom line and diluted our return on sales. Now, another way of looking at our profitability is what is the return we're making for the amount of money that has been invested. Now, an operating measure of that can be the return on capital employed. And here what we're looking at is what is our operating profit, or in this case our EBIT, divided by the net assets for the organization, or what is referred to as the capital employed in the organization. So return on capital employed can be quite a common measure, just to say how well are we turning our capital and turning it into profit. Now, in this case, if we have a look at this, our earnings before interest and tax divided by our net assets, we can see for 2026 that Smart Retail was 26.2%, and for 2025 was substantially higher at 35.5%. Now, what we need to do is we need to be able to understand why is that movement? What's actually caused that? We've seen a little decline in profitability, but clearly there was an increase in the assets as well for the organization. Now, we'll just note at this point that to calculate this properly, we really want to be using the average net assets for the year. So we're measuring our total return over the average of those net assets. Now, the last operating efficiency ratio that we'll have a look at is our return on assets, or return on total assets. So we're looking at our net profit after tax or our net income, and we're dividing that by the total assets that are invested in the business. So if we have a look here for Smart Retail, we can see that our net profit after tax, 281.1, divided by those total assets of 2,924,000.6 equals a 9.6% return. Again, this really becomes more meaningful when we compare it against other industries, other businesses, or competitors. But also then let's look back to the last year. And last year we can see that that same metric or the same ratio was 13%. So again, what we can see is there has been a decline in terms of our profitability or an increase in our total assets invested in the business. Now, just as I mentioned for the return on capital employed, really we want to be looking at the average total assets over the year rather than just looking at the ending assets. That gives us a better reflection on the returns that's been made over those average assets. Now, what becomes really important with the ratios is that we don't just churn out a set of numbers. We've got to investigate and find out what has been driving that change in performance. And here, if we summarize those results, we can see for Smart Retail that the gross margin, that percentage reduction, was due to pricing discounts that have been offered to try to keep those sales up at the right level. That 1% reduction from pricing really flowed all the way through to the bottom line, which is something we've always got to be cautious of with pricing, that it can have that effect that ripples all the way through to the very bottom line. So we saw that reduction in our operating margin and also in the our return on sales or the profit after tax measure. Now, we then saw a bigger decline in terms of our return on capital employed and also the return on total assets. Well, the big driver of this was because our cash balance increased, and over the year we'd actually managed to generate more cash. Now, that's not a bad thing. It's good to have the cash, it's good to have the stability. The challenge that would be the discussion for the organization is, do we want to keep that held in cash or do we want to be investing that money to try and get a better return on it? But once again, it's not necessarily a terrible thing to be increasing our assets or increasing our capital employed because of an increase in cash. So there we have a quick overview of 5 key ratios within that operational performance analysis. Join with us for future videos as we will go through and understand some of the ratios to assess a company's liquidity, their overall operating efficiency, their financial structure, and their investment performance. If you're interested in learning more about financial statement analysis, have a look at the online course which is included in the comments below. It will take you through some of the steps we've covered off here, the introduction to the financial statement analysis, and through that we'll give you also a summary of Smart Retail's financial statements so that you can work through those numbers and go through the calculations. It will also go through each of the steps, the operating performance, profitability, and bring through a real world example. So we'll have a look at the real company and see how this translates in the real world. And it will also be supported by short activities at the end of each section so that you can test your knowledge and make sure you've got a good thorough understanding. Each of these steps and that we'll work through on the course will be supported by short little videos like what you've seen in this particular video. And at the end, it will also come down to a summary section to summarize what does it all mean, how do we use it, and what other information do we need to consider.